Welcome, everyone, to another North Road podcast. My name is Cary Williams, Director of Research and Portfolio Manager at North Road Investment Counsel. I am joined today by my colleague, Cory Knott. Cory, how are you?
Doing good, doing good.
I bet you are. Just off a vacation. Where were you?
Malta. Yeah.
Malta. Could I put that on the map? I don't think off the top of my head I could go to a map and point out Malta, but pretty sunny. It was nice.
Really nice. Yeah, it's right jammed between North Africa and Italy. And
Awesome.
Really small country. It's awesome. Amazing.
Perfect time of year to go.
Yeah, it was great.
Awesome. Are you going to retire there?
Not bad, not a bad spot. Not a bad spot to do it. Food's good, weather's good. Can't complain.
Let's talk about how you're going to pay for that. See my segue there? Wasn't that amazing?
Exactly.
Okay,
yeah,
we're going to talk about retirement spending, 4% rule, withdrawing off a pot of money. We'll bring in Cory's retirement to Malta into this potentially, and get things going around that. Cory, I just brought up the PowerPoint here. Can you see my screen now?
Yeah.
Okay, awesome. 4% withdrawal rule. Let's go through the history, Cory. I want you to hop in here, ask a bunch of questions whenever something comes to mind. Be the audience here. I know you're familiar with the original 4% rule, but today I'm going to talk about this new research that has been done by the same researcher, William Bengen. He's got a new book. I don't know if it'll show up too much, but A Richer Retirement. This is his update to the research that he did back in the 90s, and the book is fantastic. It's one of the best finance books I've read in a while, 272 pages. It's taken me a couple weeks of kind of reading at night before bed. This is what I do as an investment nerd. Yeah. I read, before I go to bed, investment books. But I think it's going to be really valuable. I'm excited to hear from you today about how you think it might change financial planning when you do it. And please, as I said, ask questions as we go and be the audience. Okay.
That sounds great.
All right. Here's one of my favorite quotes, Cory, when it comes to retirement planning. This is from William Sharpe, different William, but famous for the Sharpe ratio, Nobel Prize winner. And he is on the record as saying, drawing from a pot of money in retirement, that decumulation, as finance nerds like to call it, is the nastiest, hardest problem in finance. All right. And no surprise to you, Cory, but it might be a bit of a surprise to the audience. Like, why is taking my own money off of my investments the hardest problem in finance? And quite simply, there are so many assumptions, right? Cory, when you do a financial plan for somebody, how many assumptions go into the back end of this thing?
Tons. And so dependent, and they're so different based on the person.
Yeah. So the customization, right? Yeah. Customization is one, and to the person, but also potentially to the economy we're in. Right? Like inflation, investment returns, all of those numbers that we have to figure out are assumptions that dramatically impact a 30-year outcome.
Absolutely. Yeah. And things we can't control.
Yeah, absolutely. So in that kind of regard, as far as this being the nastiest problem, let's look at the 4% rule, which is something that came about as an answer to this problem. So late 80s, early 90s, William Bengen is a financial planner. He's talking to other financial planners about how he helps his clients who are retiring, and he realizes that nobody has a solid, consistent strategy for drawing off a portfolio. And some even say things like, I'm getting 7% in my portfolio so I can spend 7% a year. And we know from the research since then that that's just not true because of sequence of returns risk. So this idea that if we get negative returns early in retirement, that has a bigger impact when we're drawing off our portfolio than negative returns at the end of retirement because of compounding over time. So let's dig into the history here, Cory, and explain where we started in the 90s with Bill's original research, and then we'll go into the new research.
Okay. That's great.
So Cory, there's a really important word here that we got to define right away, safe max. This is how Bill Bengen described the safe maximum amount as a percentage that someone could pull off of a portfolio. Okay. How did he get to this number? Well, what he did is he took, again, a bunch of assumptions to get back to how we started up at the top in his research, and he tried to keep things really, really simple. He said 50% stocks, 50% bonds, over 30 years, S&P 500, intermediate government bonds in the U.S. Okay, U.S. based, so he used all U.S. information. And he said, okay, if I take this super simple portfolio, 50-50, and I map 30-year periods with this portfolio going back to 1926. So pretty robust, pretty gnarly history. We've got the Great Depression. We've got 2 world wars. We've got inflation in the 70s, inflation in the 40s, 50s as well, like pretty tough periods. And what he did is he said, okay, in each year, if you retire over the next 30 years, how much can you spend off the portfolio as a percentage, adjusted for inflation, and not run out?
Yeah.
Okay. So Cory, I don't know about you, but as a financial planner now, looking back, this seems like the simplest, most basic research. I'm shocked it took until the 1990s for somebody to do this.
100%. Yeah, you're not wrong at all. Especially when you look at these assumptions, and it's funny because you think of the 4% rule and things can easily slip your mind, like, oh, it's 30 years, right? The timeline it's based on, what markets are it's based on. So it's interesting looking back at some of these based on what we have now.
Yeah, absolutely. So one of the things that he discovered was he said, okay, right here, this red box, 19, I think in this case it was 67 into 68. He discovered that if you spent more than 4.15% in that 30-year retirement, you ran out of money before the end of 30 years. Okay, super simple, tons of assumptions, but this gave him the idea that 4% or thereabouts is the safe maximum you should spend off a pot of money, because in every other 30-year retirement, you were okay. Good so far?
Yeah.
Okay, let's keep going. He also ran some information that is really, really interesting. And he said, okay, let's look at stock allocation as a percentage of the portfolio and see if the amount of stocks you hold changes things. And right here, you can see that for the most part, between kind of 40% and 70% stock allocation, it all comes in at about the same percentage, about 4%. So the stock allocation didn't appear to change the ability to spend money in this safe max scenario. Okay, good so far. Any questions there, Cory?
No, I don't think so. I think this was just surprising to me, right? Like to see how little it changes between a 40 and 70% stock allocation, because that's quite a massive difference. So it's surprising to see how large of a steep incline there is at the start there as you add the stock allocation, and then how much it levels off between 40 and even 100%.
Yeah, I think this part in particular, Cory, is really important. There used to be a rule of thumb that I don't hear about very much anymore, but there used to be a rule of thumb that said the amount of equities you should have is 100 minus, no, other way around. The amount of bonds you should have is 100 minus your age. Yeah. Right. It's so long ago that I heard it, I can't even repeat it properly.
Yeah.
Right. So if you're 70, you should have 70% in bonds and 30% in equities, the way I just described it. And he's saying in his research, like, listen, that's maybe possible, except the amount you can spend in retirement drops dramatically if you reduce your equities that way. Okay. Yeah. Based on his assumptions here.
Yeah. Now, one other thought I had, Cary, I don't know if you want to touch on this now or later, but the other thing I'm surprised about is that there's a dip at the end going to 100% equities. And I know there's research out recently, some of the stuff with Scott Cederberg showing 100% equities may be better. Do you want to touch on that now, if I throw in that kind of thought, where that surprises me too, to see that the safe max goes down with a 100% equity portfolio?
Yeah, let's touch on that on the new research, because the new research gets really, really in depth, way more than this. And so let's wait until we get into his new book.
Great.
The other thing that is really fascinating that connects to this equity allocation portion, Cory, is that what he did next is he said, okay, let's take those allocations, again, fairly naive, 0, 25, 50, 75, 100% stocks, and let's look at what happens to safe maximum withdrawals. Okay, again, we can't really say worst case scenario, but in his data, worst 30-year period, right? And let's see what happens. And this is fascinating. So that same period that we looked at before, every single allocation is almost exactly at that kind of low fours number. All right. So in these gnarly periods where, and we're going to talk about why this happened in that period around 67, 68, in these gnarly periods, no matter how much equities you hold, you drive down towards the safe maximum. All right. The big difference in equity allocation is what happens in all the other scenarios where you don't get this kind of safe maximum limit that happens. And you can see in, say, the 40s, if you and 50s, if you retired in the 40s and 50s and you had 100% stocks, you had an absolutely unbelievable spending rate as your safe maximum.
Yeah.
You know, like look at, I think this is 48 right here. You could spend 13% per year off your portfolio. That is just unheard of today, right? And this idea that we would even be able to do that. Now, again, this is all hindsight. It would be hindsight bias. At the beginning of your retirement, you would never spend that much. You'd be too afraid of what the future held that you couldn't predict. But in hindsight, really, folks retiring here probably left a massive inheritance.
Right, and that's what I find so interesting with the 4% rule here is that it's at a bottom, but in those other circumstances, it leaves a large amount of money left on the table, which is interesting to see, and how they all convert at that one spot, but these other time periods provide such a different spending.
Yeah, absolutely. The detractors of the 4% rule would say, listen, in almost all scenarios, you underspend in retirement if you use this as your guiding principle for spending in retirement. Cory, I'm going to tell you a story I may not have told you yet about my dad. Okay, my dad is, so let's say for 30 years ish, my dad has let me know that there will be $1 left when he dies for me to inherit, and I should be prepared. Okay. Amazing. Consistently, yeah. This comes up every few years. Be prepared. There will be $1. Okay. Here's the thing, right? If you're using the 4% rule to guide your spending, it is impossible to maximally spend your investments in most scenarios. Let's call it, for extreme purposes, 99%. I mean, it's not that case based on this data, but that's, I'm being extreme to prove a point, which is if my dad really believed that, then this is not a retirement spending foundation in which he should potentially look at. Does that make sense?
It does. Yeah, absolutely.
Because he's going to dramatically underspend if he does this in order to prevent some sort of catastrophe in his spending later, right? Outliving his money. And as a result, I'm going to get a bigger inheritance and he's going to be just as disappointed, except maybe he's in the grave and doesn't notice. No, that's
I was going to say, well, this might work out well for you then, right?
Okay. Last one here touches on what we just said, which is what happens with stock allocation to the amount of your, well, in this case, he uses median bequest, so sort of middle of the road, a bequest or legacy or inheritance. And you can see the more you add stocks to your portfolio, the more likely it is that you leave a large inheritance. Okay. And the reason for that is if you're only spending 4%, but you have this scenario where your returns or inflation or any of those other assumptions are in your favor, so to speak, you leave a ton of spending on the table, for lack of a better way to put it, because your portfolio is just growing so much as far as like real spending rates and rates after inflation. Okay, Cory, anything on the sort of history that we missed that you feel we should touch on?
No, I think that was a really good recap. What I'm really interested to see is this new 4.7 rule and how it plays out.
Yeah. So in the new book, Bill Bengen makes a bunch of new assumption changes, reruns the data, including new data, because of course it's, roughly, what's my math at? 25 years later, let's say, almost 30. And redoes that information based on more, I'll call it modern portfolio theory, for lack of a better way to put it. Not exclusively that academic term, but just this idea of diversification. He also digs really deeply into each individual assumption and how it affects the outcomes. And so for financial planners like you and I, or just investment and retirement nerds, this book is just unbelievable because it really digs down into what are the real drivers, or in academia, we might say factors that are driving the outcomes on this safe max spending rule. Okay, awesome. Let's talk about the change in assumptions. First and foremost, remember there were two assets before, bonds, stocks, and he used the S&P 500, so large company stocks in the US. In the new allocations, he adds micro stocks, small stocks, and mid-sized companies from the US, international companies, so everywhere outside the US, I believe. I don't think it's just developed. I think it's emerging, but now that I say that, I might be wrong. As well as a little bit of cash equivalents. So okay. Significantly more diversification. But again, it's pretty naive, right? Like he's just doing, exact same weights across all of them.
Right. And another thing that pops into my mind looking at this is still, if I'm understanding correctly, 89% US, basically. right?
Yeah,
Yeah, okay.
enormous weighting to US.
Yeah.
So, Cory, one of the things that I took as I read it a bit of umbrage to, which you are going to touch on, and I think it's the Brinson data that talks about safe withdrawal rates with international. If you look at it from a local's perspective in a different country,
Right.
let's use the most extreme, which is say Germany over the last century, or maybe Italy, right? Those folks that lost world wars, for lack of a better way to put it. Their outcomes are dramatically different than U.S.
Right.
investors if they hold 89% of their securities, or held 89% of securities in their local markets.
Right.
Okay. But I think, Cory, being a North Road guy who believes in massive diversification, do you think that this type of diversification improved or made worse his 4% rule?
I think it would have compared to 100% equities before, US equities.
Well, let's say his 50-50 with just US and bonds. So here
So
we're like 55-45 now, a little bit more equities, but we're diversified by size, we're diversified by geography. Like, which one do you think has a higher spending rate in that safe max scenario?
well, actually, it's thrown me off a bit. And why I say I'm not sure is I immediately think if they've removed some US, then less, just because how strongly US has performed, right?
Yeah.
Especially large companies over the last, whatever, 10 years or so. But also adding some of that diversification usually helps. So I'm a kind of at a conflict of mindset here when it comes to that. I think it would have helped though.
Yeah, that's an excellent. I'm going to call that the Malta hedge. You've been on vacation. Your brain can't make a
Yeah,
decision yet. Yeah,
I'm
yeah.
not computing fast enough yet. I'm like, give me a break here.
That's so funny. But I think the way you're thinking about it is right. We know that the U.S. has been one of the best investment markets over the last almost 100 years. At the same time, we've diversified a little bit into international markets. What happens? And what we find is that the safe max actually goes up. So it goes from 4.1%, let's call it, to 4.7. He's rounded, it's actually 4.68, but he rounds in all of his charts. So what he actually finds is that level of diversification with roughly the same other assumptions gives what he's calling the 4.7% withdrawal rate. And so, Cory, 4.1 to 4.7 doesn't sound like a large number, but 0.5% compounded over 30-year retirement is an enormous number. It is a lot of spending. And if we're thinking from the perspective of, in my retirement, I've worked really hard, I've saved really hard, I've foregone spending during my working years in order to have this pot of money. An extra 0.5% in spending per year over 30 years is dramatic. It is a significant amount of, I'll call it joy, that I'm missing out on in the safe max scenario, let alone all those other scenarios where I could have spent way more because of how the assumptions played out and how my particular path played out over my 30 years. Okay. Here's what's interesting about the chart you're seeing right now. Okay. So you've got retirement date, 1926 to 2012. 2012, because 30 years from 2012, right, takes you way, way, way ahead of even where we're at now. He's done some assumptions here around the last little bit to give a little bit of extra data because we're looking at long-term horizons here. But what he finds is there are 1, 2, 3, let's call it 4, 5 sets of retirement years that are situated so that their spending levels at 4.7% last less than 50 years, 50. So in the vast majority of instances in the data he's now running in the new book, you could spend 4.7% for more than 50 years and not run out of money.
Interesting.
Really interesting. Like this blows me away. This is that idea of like dramatic underspending in many, many, many scenarios. Think about if your money can last you 50 years and you're only retired for 30, think about how much more spending and joy and charitable giving and giving to kids and grandkids and travel and all those things you could be doing, right? And if we're following the 4.7% rule, we're sort of giving that up in order to have the safety of not having to worry about unexpected outcomes in the future.
Yeah. Yeah, that sounds really interesting to me because you think of the 30-year horizon, so it's really I really like this a lot, to put it on a 50-year timeline and see where it doesn't work out, and to see how few and far between they actually are. That's really surprising to me. Actually, I would have thought it would have been a lot more scenarios in which it couldn't go to 50 years.
Yeah, and Cory, you've had this experience where you're talking to a client about financial planning, right? And you're trying to figure out, how do I make this a conservative plan and still allow them to have the life they want? And I mean, I think it's pretty natural to say, okay, let's look at the worst scenario in history we can find and use that as our baseline, where in actuality, we might be doing a disservice by not helping them, create ideas on how to spend more and have a little more joy in their retirement.
Totally.
Yeah. Okay, let's look at equity allocation again. So we looked at a very similar chart to this. So this is using his, again, 7 asset classes, so more diversified portfolio, and looking at what happens with stocks and allocations to stocks. And I'm going to highlight right here. He gets super granular. And you can see right here, we're between 4.65 and 4.65. And everything else is basis points higher, not much, right? And again, it's 45% to 70%. Right? And so we're talking very minimal differences in safe max spending rate between 45% and 70% allocations to equities. And again, same thing we talked about before, falls off on both sides of that. So we get this sort of optimization hump around equity allocations.
Right.
Fascinatingly enough, he looks at this again across longer time frames. And so I'm going to show that chart, because that part is fascinating to what you just mentioned earlier, which is, if we're spending so little, what happens over long periods of time?
Yes.
All right, so let's go and we'll talk about planning horizon. I love his terminology of planning horizon instead of like retirement or, retirement to death date.
Yeah.
Right. Really, what he's saying is like, how long do you want your money to last?
It's a
much
much
better talking about
way
retirement, right? Yeah.
A way to phrase it, right?
Yeah. And he says, he's very clear. He says he thinks you should take longevity, which is inherently an unpredictable number. It's a best guess, so to speak, and really put on a conservative number of years after to make sure you don't run out of money. But
Yep.
I love this chart because he says, okay, 1968 retiree was the toughest safe max we could find, as far as having a very low number. It came out at the 30-year point to 4.676%. So I mentioned he's rounding up. And then he looks at the planning horizon. So what if I wanted to plan for fewer years from there? And what if I wanted to plan for more years from there? So we touched on this idea of 50 years, right, on that first chart, and how in most instances you actually are okay spending 4.7%. You may be even underspending at that point. Look at this. So in the safe max scenario, 1968, that worst year to retire, he finds that even over basically a 50-year spending retirement, the 4% rule, the original rule, still works.
That's shocking. Like, this graph, I think, is super interesting. It's the first time I'm seeing it, and and even going all the way to the left, right? Like, seeing how much that increases as well. Because when we're building financial plans, it's so drastically different. Everyone's, even just retirement time horizon. Some people enjoy their work and are working later. Others are trying to retire earlier. So it's so interesting just to see the timeline here of how it changes based on how long you need that money to last, but how that 4% goes all the way out to 50 years in the worst case scenario.
Yeah. And I think it's important to note, it's really surprising. I was blown away by this chart for 2 reasons. One is, it's important to note that this assumes you spend all your money at the end of each of these periods, right? You're down to zero. You're down to Cary's dad's $1 in the bank, basically, right? It's the Cary's dad's rule here. But the other one is we have this FIRE movement, right? Yeah. Financial independence, retire early movement, that has been using the 4% rule because the data was, as good as you could sort of get, so to speak, up to this point for really long periods of time. Like people talking about retiring in their 30s and spending 4% of their portfolio and thinking they're going to be fine for, 60 years or more. Yeah. And for guys like you and I, this just gave me like hives, like the hair on the back of my neck stood up hearing these guys talk about, I'm just going to use the 4% rule for the rest of my life. And it's like, yeah, the data doesn't say that. You can't do that. And now the data says that.
You're like, oh wait, I guess you could have. Yeah, maybe. Yeah.
Again, tons of assumptions, not customized, all those things, right? But yeah, I'm with you. This chart just blew me away.
Yeah, really interesting to see this, actually.
Okay, let's touch on equity allocation as it relates to planning horizon, because this as well I think is maybe number 2 to just blowing my mind as to the research that Bill Bengen did. So again, 1968 retiree. So this is the safe max in the original research. You spend more than 4.15%, you run out of money in less than 30 years. So what he does is he says, okay, let's look at planning horizon against how much you put into stocks. Okay. And he says, okay, if I only put in, let's say 50, because that was on the lower end, right? How does that correlate to my planning horizon? All right. And the optimum stock allocation for each level starts to pop up here. So he says basically, right, as you get farther out into your planning horizon, so if you're going towards that 50-year mark, you really should have more allocated to equities. Okay. If you're saying, okay, if I'm only planning 24 years, being more conservative, requiring less growth because my time horizon is not as long, is actually reasonable. You can optimize based on his assumptions, your asset allocation based on your planning horizon. And we've always had this idea, Cory, I think that, I'm early in my career, so I've got lots of years to make up for a downturn in the markets. I should go heavy into stock markets, right?
Right.
And in a way, to me, this is sort of a similar perspective, right? We're looking at retirement spending, but it kind of tells us the same thing, which is the longer your time horizon is for pulling money off of a portfolio, the more you should track towards equities. And in this case, it's not because you can recover, it's because you need that growth for it to last.
Right. Yeah. Super interesting. And I noticed their tax advantaged account under the assumptions there.
Yeah, so U.S. based again, and so that's a bit of a weird terminology for Canadians, but basically he hasn't looked at tax in the vast majority of the charting here.
Gotcha.
Okay, I've got a couple of charts where he does look at tax, but he basically says tax is so custom, it's so individual that it's really hard to do kind of generalized research and generalized planning around it. So he does touch on it, but he basically says, hey, here are some tax rates and here's how it's likely to affect the withdrawal rules.
Okay.
All right, let's talk about the 2 things he finds that are not just fascinating, but most impactful on a retiree's withdrawal rate. Okay. The 2 things are, do you know, Cory, can you guess, or should I take it easy on your multi-vacation brain and tell you what they are?
Shoot.
Okay. So valuations. Okay. So what are we paying for stocks, and inflation? He also says taxes, but again, because taxes are so customized, he doesn't really touch on it very much, but he touches a lot on valuations and on inflation. And interestingly, if you read through the book, he uses valuations because in actuality, it's bear markets. It's significant prolonged downturns in our assets that affect our spending levels. And then he says, but we can't predict when downturns are coming and how long they're going to last. And so the best thing we have that's kind of a proxy is valuations, because higher valuations generally mean lower future returns. So in the book, he uses CAPE, cyclically adjusted price earnings. Very simply, for folks who may not know this terminology, the data sort of looks at a 10-year period and tries to look at valuations over a business cycle or a couple of business cycles over 10-year periods rather than kind of year to year. That's my simple version there. So I got a bit cheeky in this title slide. I said, okay, let's look at CAPE. High CAPE, which is actually high valuations, which is actually a proxy for bear markets or downturns. And so this is a chart. There's a lot here. So Cory, I'm going to walk through it. If I don't explain this well, hop in, okay? But we look at CAPE on one side. We look at the maximum percentage on the other. CAPE is in orange. Maximum percent that you can spend is in blue. And we look at the same set of years and the same assumptions. 7 asset classes, 30 years. And here's what he's trying to show. He's trying to show that when valuations are high, like the dot-com boom, our spending rate is lower. When valuations are low, our spending rate is higher. Okay, low, high. It's not a perfect connection, but it's pretty close, right? Like there's some data here at least that gives us something to work with.
Right.
Does that make sense?
Yeah, it does actually. and not surprising, but when it's laid out in this way, it's interesting to see them, going against each other in almost perfect order, right?
Yeah, and I think for guys like you and I, Cory, that are doing financial plans and we're trying to figure out this problem, which is how much can we safely take off of a portfolio, or how much can our clients safely spend off their portfolio, not run out of money before retirement's over, balance that against trying to achieve as much joy and travel and giving to kids and charities and all those things that we have in retirement. There's this balance that we have to find. And I think incorporating this concept that, hey, when valuations are high, we may, if we're retiring around that point, we may want to, bring down our expectations around
Right.
around safe max spending.
And how does it just go till 2013? Does the book talk about anything of, where we are now or where we have been the last few years?
Yeah, he doesn't specifically talk about what's happening right now,
Okay.
but he does say, listen, we have very few instances of high CAPE, high valuation years in the past. And as a result, the data is scarce. And so we need to be extra cautious. Okay.
Yeah.
But the inflation data that he pulls together actually touches on this in a really interesting way. So the second thing he says is inflation is really, really, really important. So he says if you have high valuations and high inflation, this is the killer, right? This is the 1968 retiree,
Yes.
1970s inflation, poor returns in the 70s as well. I think 2 bear markets in short order in the 70s. And so what he does is he lays them out like this, which I thought was really fascinating. He sorts 3 different inflation scenarios. So he says if your retirement is a low inflation retirement, a moderate inflation retirement, or a high inflation retirement, and he uses 2.5% and 5% as the per year as the cutoff. Again, pretty naive research, like delineations, pretty naive situations, but it gives us the general pattern, right? And then he says, okay, let's combine that with CAPE. Okay, so he says for each of those inflation scenarios, what happens to our spending rate as we get higher and higher valuations? And we can see that our spending rate comes down. As valuations get higher, spending rates come down. And our top spending levels come down with inflation.
Right. So those percentages on the side are the safe max withdrawal percentage. Is that what that is?
Yeah, on the right side here, over here.
On the right side. Yeah. Okay.
Yeah. So you can see like when you've got high valuations and inflation, like that's not a huge difference between low inflation and high inflation if your valuations are on the higher end of each regime.
Yeah, that is surprising. And then it's surprising to see all the way up to what 16% there on the extreme case, right?
Yeah, over here on the like low valuations and low inflation. Now I'm sure that the number of data points for that is very low, right?
Yeah,
and so how statistically, secure is that? I don't know how high my confidence would be, but I think the general pattern is there that valuations and inflation are super, super important when looking at retirement, and especially this model of safe max, of setting the percentage I can spend at the very beginning of my retirement and only adjusting it for inflation. All right, let's talk about taxes because I'd not seen research about this before. And so this is really interesting. He touches again, same 1968 retiree. So that gnarly high inflation, high valuation environment. And he looks at what happens if your portfolio's overall tax rate increases. So he goes from 0 to 44%. And what happens to the retiree's safe max? So it goes from 4.68 and gets cut, not quite in half at that level, which I mean, on the surface is not maybe that surprising because you're getting pretty close to a 50% tax rate. So, there's a lot of assumptions behind this, but it does give some guidance at the very least. So, I think it would be rare to find too many retirees that are 25% or more in their average portfolio tax rates. But it does drop that tax, that safe max pretty dramatically as you get beyond, say, that portion. If you can stay below, say, 15, it really helps quite a bit.
So then, Cary, explain this to me in the sense that, so this 4.68, that's assuming no tax at all. So if we average, say our average retiree is 25%, they should then be considering something closer to, what is that, 3.7-ish range? Is that what I'm looking at here?
Yeah, that's how I'm reading the data,
Okay.
for sure. And, in the past, when folks would talk about tax, I would say, well, include your tax in your 4% rule,
Right.
right? So if you're taking dollars out to pay tax, then that has to be your spending has to be 4% minus whatever you're paying for tax.
Right.
Okay, so it's not necessarily that different from here, but we've got maybe some more concrete numbers now.
Cool. Okay, that's really interesting because that does change, right? If you're running you're using a rule of thumb and you're running those numbers in your head, and it's going to depend on, are we looking at an RRSP or a TFSA? Those numbers can then possibly change depending on, what your tax liability is going to be and what you're
For
expecting
sure.
to spend.
Yeah, and it gets even more in depth, Cory. If you were to go, this is all just retirement money, right?
Yeah.
Decumulation, taking money off a pot of money, or taking dollars off a pot of money. What happens if you take it the 30 years prior to this, and you're looking at your tax rates in employment, and you're using RRSPs to try and reduce your high tax rate so that you have a low tax rate in retirement? That probably changes this again dramatically,
Yeah.
as well. And he doesn't get into that at all because, I mean, one, he's in the U.S. It wouldn't be, and he knows
Yeah.
it wouldn't be prevalent or useful to Canadians, and everybody has a different tax rate on all those things. So I think just general here, we see that taxes can have a pretty significant impact.
Yeah.
Okay, let's talk about leaving money. So we mentioned this at the beginning that when you use the 4% rule, you actually underspend in most scenarios. And logically, that would mean you leave a fairly significant retirement, inheritance. And so same thing here, 4.7% rule, 30 years. And we can see right here, that's the 1968 retiree that he talked about that was so gnarly and creates the safe max out of that year. We can see those couple of scenarios that I mentioned in that one of the first charts where we get close to that same safe max but don't get there. And then we see all of these other scenarios where you're just leaving enormous inheritances. And so what he's done here is he said, okay, if we start with $100,000, what's left over using these assumptions? And the part that I marked is almost $500,000 and above is left after spending 4.7% over 30 years. So you end with dramatically more than you had after spending all the money you wanted to in retirement.
That's surprising, hey?
Yeah. So I can tell you a guy like my dad who wants to leave $1 left, right? He wants to like take the paper that this is printed on and crumple it up and throw it in the garbage, right? Because he's like, I'm leaving way too much money.
So then does he talk about, it's hard because we can only know these things in hindsight. So how do you know when you're in a situation where you can take more? I think that's always the challenge, right? And I think that's why decumulation is such a nasty problem, right?
Yeah, for sure. I should just end the podcast right there because that's like, I would just brought it right back to the beginning, right? You just did a perfect job. You should have saved that for 5 more minutes and you could have used it as the end. So here's what he does that is really fascinating, Cory. And I didn't go into the charts here because I thought they would be kind of boring visually, but he actually does the math to connect valuations and inflation to individuals' custom scenarios. In there, and there's charts for, what do you expect your inflation rate to be, and what do you expect, or where are your valuations at right now? As a result, here's your personal custom safe max. Like, it's unbelievable the math he's done. Again, so many assumptions that I'm not sure I would, bet my own money on it, but the value and what he's done. I mean, he's retired now, so he did this for fun. Wrote this 272 page book with all this research, but yeah, he does dig into that a bit more for sure.
Cool.
This is interesting. So this is same data, except this is adjusted for inflation. So real legacy is what he calls it, like there. Okay, so 4.68% gives you $0 in inheritance. If you want to leave, say, $100,000 in real dollars, so it grows to provide you with $100,000 in spending, 30 years later, then you need to spend 3.7%. If you want to leave $400,000, then you can only spend 0.75% of your portfolio.
And again, this would be based off of that worst case scenario.
Yeah, the 1968 retiree right there. Yeah. So again, he's trying to answer all of these problems that people come to us with, which is like, hey, I want to leave $400,000 to my kid, right? And I've got $100,000 to start with. What do I do? Okay, well, you really can't spend any money. That's what that means,
Yeah.
right?
Right.
0.75% is your spending. Okay.
Yeah.
But another way to look at this, Cory, is to say, as an example, some of the modeling that we would do in a different way is to say, I've got 100,000, I'm going to put it in an account for my kid and they need it. I'm going to treat it like a trust. I'm only going to help them with a little bit of money every year out of it. And I want
Right.
it to be worth $400,000 in 30 years. What can we take off of it?
Yeah.
Right. So
And those
again,
are
I think
some,
pretty fascinating.
yeah, and just some, great rules of thumb. Rules of thumb are always tricky and everyone's scenario is different, but it's nice to at least put something to those big questions that people are getting asked all the time, right? And that we're getting asked all the time. So it's nice that he's put it in a way which you can at least map it out in a way that you can put some numbers to it quickly.
Yeah. Cory, we're getting to the last section that I wanted to talk about, and I'm having so much fun talking about this with you because I know you're as much of a financial planning nerd as I am. I think we're into about the 35th minute, so this is way longer than I expected it to be, but let's keep going. We'll finish up,
Cool.
and you and I can talk about some implications. So what does he not touch on, or maybe more accurately initially, what does he touch on that he doesn't really work through too much? He actually puts this chart in the book. This is David Blanchette's retirement smile chart that looks at and says, okay, there's some good research that says that over retirement years, at least US retirees over their years will decrease their spending down towards sort of that 10 to 15 year period in retirement, and then spending will come back up a little bit, which he called the retirement smile spending. Lots of sort of theories as to why it's a smile and there's increased spending at the end here, Cory. But I think in the US data in general, the theory is that you've got this healthcare cost that creeps in towards the end of life. I haven't seen much data for Canada. I saw some data quite a few years ago that actually surmised that in Canada, it was more like an S because we don't have as much long-term care. We have more government influence and government payments happening. But whether or not that'll change over time, I'm not sure. But he does recognize, Bill Bengen does recognize that the 4% rule or 4.7% rule may not actually be accurate to how retirees spend money.
Right.
One of the other things that does not come in at all in his book, Cory, is how most financial planners look at financial planning, right? So I've put up this chart from one of the softwares that we use that looks at income. And do you want to just touch on what's on here?
Yeah, of course. I mean, this is where I spend most of my days. So this one's familiar to me at least. So this is looking at spending and where your money's coming from and your income in retirement. So you can see those purple lines at the beginning. So each line is a year, and you can see the income on the side, and that's all employment income. So I think that's where we see people start to have this conversation is, okay, things are pretty easy. All my income's coming from one spot. It's pretty easy to manage. It's easy to understand. And then you can see as you get into these retirement years, all of a sudden you have all these different buckets that you can pull from. And now you have to start considering CPP, OAS, RRSPs, pensions, TFSAs, non-reg, corporate accounts. We can go on forever, right? And then how those all integrate together. And I think that's where a lot of the complexity comes into place and where people generally start to gravitate to rules of thumb like the 4% rule or 4.7% rule, because you look at something like this and you go, oh my gosh, what do I do? And it's like, well, let's just take a certain percentage or a certain number. But like you talked about, depending on the circumstance, maybe that leaves a lot of money on the table. And there can be so many different outcomes. But I think this just highlights how we move from simplicity and one income source to a whole bunch of different income sources and where you start to see that planning come into place.
Yeah, I think financial planners and software in particular are getting better at scenario planning and modeling scenarios as well, like high inflation and those kind of things, Cory. But I would say the downside of financial planning software in general is that still assumptions based, right?
Yeah.
And in general, the assumptions tend to be relatively static.
Yeah.
Right? We're not changing year over year. So we still get that sequence of returns problem where what happens if we get negative returns up front and good returns at the end, and suddenly we're getting, our portfolio's falling while we're pulling money off of it, and it's a double whammy. I would say in most cases that's not super well modeled in financial planning software. Would you agree with that, or is that unfair?
I think it's getting better. We have some tools now where, yes, for a long time, if you just assume 5%, 6% year over year every single year, I think that's going to give an unrealistic final number because some years are going to be -10 and some years will be +20, right? And like you talked about the sequence of when you withdraw them. But we do have some tools now where we can add in some of those at certain time periods. So we are able to stress test it. The only thing is we can't stress test every single possible outcome, but we can at least put some scenarios to it to start modeling it in. So I think it's getting a lot better. And we do this when we run the plans, is when we stress test them, is we run a few different scenarios of, if you retire at this time and what if we do see a market decline, how much does that affect your spending? So it's not perfect. And like you said, a lot of assumptions, but it is getting better.
Yeah. And we've always, I shouldn't say always, but we've had Monte Carlo for a really long time where we can model this randomness into software that's called Monte Carlo software. So we can model randomness in there. And you had touched on the Cedarburg research earlier, which I believe is doing like a Monte Carlo, but they're doing sort of 10-year chunks based on that sort of bootstrapping is the terminology. And so it definitely comes to a different realization than some of the slides we've looked at, but I think it's because the assumptions are just different. And which one do you follow? I think depends a lot on your own biases and comfort with risk. One of the things that I have been using that I think comes from the academic research that I think feels intuitively like it's very useful to clients is the idea of the Guardrails research. Are you familiar with this, Cory?
Yeah, I am.
Yeah. So the Guardrails research came out a little while after Bill Bengen's research, a bunch of assumptions behind it we won't go into, but it basically says, let's start with our portfolio, just like portfolio value, just like Bill Bengen's 4% research. Let's give ourselves a percentage that we're going to spend, adjust for inflation, and then let's see how the portfolio moves. And if the portfolio breaks a top line dollar figure, we're going to increase our spending by a certain rate. If it falls below a bottom threshold, we're going to decrease our spending by a certain rate. So one of the things Bill Bengen doesn't really touch on very much is how comfortable are you with variable spending? So are you willing to cut back your life if the future turns out to be less optimal, for a lack of a better way to put it, than you expected? If you are, then you have more options. You can spend more now, recognizing you're going to cut back. I really like this because I find that folks that are good savers through their employment careers tend to have a really hard time spending money when they retire. Do you find that, Cory?
Absolutely. Yeah, we see that all the time. Yeah.
Yeah.
It becomes very hard psychologically to start drawing down a portfolio when you've been used to seeing it increase and you've been saving for 50, 60 years, right? It's a total mind shift.
Yeah. So I find for my clients, a lot of the time it's this piece up here that is super valuable, because when we break through that threshold, if we get fantastic markets and we break through that threshold and we come back to them and say, hey, I want you to spend more money, they suddenly are like, oh, there's data here that tells me I'm going to be okay and I can do that. Right. For the person who spends a lot in their employment career and then wants to spend a lot in retirement as well, this may not be great research for them to guide their retirement spending, because if they have to cut back, they're going to have a really hard time doing it.
Totally.
Yeah. There's also some research, Cory, out of the economics world around utility and utility functions and this idea of variable spending. I didn't go into it today, but that's another model. So there's lots of models other than the 4% rule that we can use. And a lot of, a financial planner's job is to figure out what's going to work best for my client and how do I customize it and do all those things. But I would summarize this way, Cory. I would say, folks really need to take away from the new book a couple of things, but the main things are, we got to be paying attention to valuations. So you had said, well, does Bill Bengen talk much about our current situation, right? Well, unfortunately, or fortunately for those of us who've been invested, especially in the U.S. and U.S. tech, returns and valuations have gone up. Unfortunately, for future retirement planning, that could be a problem. So we got to pay attention to that. And the second thing then is inflation. And where's inflation been the last few years, Cory? Not awesome, right? And so we need to be adjusting, I think, financial plans and customizing them to this idea that inflation may be a little higher, or maybe not, a little bit of a higher inflation regime. Valuation is a little higher. That may be creating some challenges for retirement planning. And then, of course, tax. So those are the three things I want folks to be thinking about as they do their retirement planning. Cory, anything I missed?
No, I think that was a great recap, and I think it's just important to know that like these rules of thumb are a really great starting point, but it doesn't necessarily mean you should base your entire plan on it. Like you said, there could be a whole bunch of money left on the table. Everyone's circumstances are so different. Inflation, rates of return, how long you're going to be in retirement for. There's so many things to think about. So I think these things are really nice to get you on the right track and to start thinking about these things and give that kind of that ballpark in your head. But when it comes down to making some of those important decisions, like don't be afraid to talk to someone and model it out because everyone's situation is so different. And not only that, but the time period in which you do it in, right?
Couldn't have said it better myself. If you're watching this video and you think, holy smokes, I really need to get this figured out, or I really need to run some questions by Cory or Cary, reach out to us as always. If you're clients, you've got our emails, you've got our phone number. If you're not a client and you want to have a chat, just reach out. We'd be happy to talk. On that note, Cory, I'll say goodbye and we'll see you maybe next month.
Awesome. Thanks, Cary. Appreciate it.
Thanks. Bye-bye.
Bye.